Hey everybody, welcome to today's video and thanks for tuning in. We're going to be sharing with you today the 5 reasons why you should not be using an RRSP. Now you're probably saying, wait a minute, I just went through your entire playlist of RRSPs and I'm convinced I should be using an RRSP. And now you're telling me, wait, an RRSP isn't a good idea for me? No. That's not what I'm saying. There are actually 5 scenarios or 5 situations where an RRSP may not be the best retirement tool. And I'm going to share that with you. And I think when you go through it with me, you'll start to see or maybe agree that actually maybe that is a good idea. Maybe I shouldn't be using an RRSP. If that's you, put your comments below or reach out to me in the links that are in the description below the video, and I'll be happy to talk with you about how I might be able to help you. But let's just walk through this real quick. If you're new to this channel, my name is David Aaron. Thanks for tuning in. I do videos on retirement planning, financial planning, estate planning, helping people achieve their financial goals right across Canada. I work with clients right across Canada, and that's true. I am an active advisor, so I'm not just somebody that does financial plans or just does YouTube videos. I'm actually an advisor, and I love to do educational videos because I think it's important that when you have more information, good, useful information, you're able to make better decisions, and better decisions lead to better outcomes. So let's get into this right away with number 1. Now, just bear in mind, this is not in any order of the biggest problem to the least biggest problem. We're just talking about 5 in no particular order, okay? So the first one is you're a modest income earner. What does that mean, you're a modest income earner? Well, you're probably making somewhere around $50,000 or below that every year, and it's a salary income. So we're really talking about whether you have a salary income or whether you are self-employed, maybe you're not paying yourself a salary. What we're really talking about, salary income, $50,000 per year. Now, the theory behind using an RRSP is that you have a high income tax and you're trying to lower your income tax. That's one reason. The second reason is you want a tax deferral growth of your investment over a long period of time so you can compound on top of that without paying any income tax. Of course, that's another great reason to use an RRSP, but there's another product out there called a tax-free savings account. And then the other reason is that theoretically, you are going to be in a lower tax bracket when you retire as compared to when you're working, when you have a higher tax bracket. Now, that's for most people, that is the actual scenario, that most people retire with less of a taxable income than that which they were working. But what happens if you're not? So we're going to go through all of that, 5 reasons. The first one now is just you are $50,000 or less of taxable income. You're already in the lowest tax bracket. Have a look at this slide. This is an RRSP calculator. We're looking at $50,000 of employment income. Let's say you make a $5,000 RRSP contribution. Why am I only saying $5,000? Because 18% of your earned income can go into a RRSP every year. And if you are making $50,000 per year and you are living alone, and maybe you are paying rent somewhere, or maybe you've got a mortgage. But when you add up all your expenses, there isn't a lot of money left over. Look at that over the right-hand side. Just in black below the red box, I'll go into that in a second, $40,000. That's your after-tax income if you had made a $5,000 contribution to your RRSP. So it doesn't leave you a lot of room to contribute your maximum RRSP contribution, which would have been $9,000. Now, you might be able to do that if you're living at home and you're able to save all those expenses that you would have had if you're living outside. Maybe you have a spouse or partner and they're paying for much of your bills, and so you can make a $9,000 contribution. But the idea here is it's going to be tough for you. But if you look at this, $50,000 of income, $5,000 of RRSP contribution, in that red box on the right side gets you $1,383 tax back, because you deposited $5,000. So you're already in the lowest tax bracket right here. So you're getting 15% federal tax back. And then you've got your Ontario tax together. But the idea is, you see the $48,535 on the left, and then it goes all the way up into the second tax bracket at $97,000. So that's the graduated system we have in Canada. For every dollar you make above $48,535, you pay 20.5%, on that amount. For every dollar that you make above $97,069, you pay 26% on that chunk of money. So as you make more money, you have to pay more income tax. So if you're making more and more money and going into those tax brackets, then it makes sense for you to use an RSP. But if you're not, see, the idea would be you're trying to make a contribution that would lower you into those lower tax brackets. But in this case, you're already in the lowest tax bracket. So the only thing you're getting back is the 15%. So what I would suggest to you, and first of all, if you want to know just more detail, if you're coming to this video without seeing the other videos in RSPs, pay attention to this playlist. You're going to have everything from what is an RSP, how to contribute to it, how to withdraw from it, kind of taxes, everything about an RSP and converting to a RIF in that playlist. So you may want to have a look at that. But what you might want to do is just allow your RSP room to accumulate over time. And when your income does start to go up over the 50,000 into the 60, 70, 80,000 or much higher, that's when you should start using your RSP and start filling up that room that you didn't use and get all that tax money back. So it makes sense to do that. Now, what if another hint here, what if your RSP contribution is below $6,000? The average contribution across Canada is about $5,500. So what if you are the average and you are contributing less than $6,000, then a tax-free savings account might be a better option for you, okay? But look at those RSP videos that I have, because that would give you a lot of great information as to how to use an RSP and if you should use one at all. Okay, the other issue here is when you look at this slide, I talked earlier about when your income is theoretically supposed to be lower in retirement, but what if you have Canada pension plan, an old age security, you have some pension income from your employer, you work for the government, so maybe a public service worker, teacher, you've got some kind of defined benefit pension, and maybe you've got some other income like rental income. Maybe you're working part-time during employment or part-time during retirement. So what happens is your tax rate starts to go higher and higher and higher, and you pay into that. You flow into those higher tax brackets. So this is the idea around using an RSP, is trying to forecast what your life might look like as you get older and older, and what kind of income streams you might have in retirement. So it's really important. If you're making $50,000, you're in that 15% federal tax rate. So it's probably not the best choice for you to use an RSP. Okay, number 2, we're looking at if you have a pension. If you know you're going to have a pension, so you are a government worker, fireman or police officer or teacher, those kind of professions have defined benefit pension plans. Well, you're going to have a sizable amount of money that's going to come to you if you stay right to retirement, that you're already going to have your retirement kind of funded for you already. And you're going to know in advance what that number will be because it's on your pension statement every year. So you'll know if you work to this date, you have 100% full pension and it's going to be this amount of money and it'll last your entire life. All these kinds of variables, right? So let's look at this illustration. I think it's really useful for you to see visually how that looks for you. The average, that gray box, the average Canada pension plan plus old age security in Canada right now, add those two together, is $19,299. So that's a taxable income, by the way, your Canada pension plan and old age security. So that is if you contributed your maximum, or the average, this is what that amount would be. Now, what if you had a pension? Well, let's just look at an Ontario teacher. An Ontario teacher's average pension right now is about $46,000. So if you add the two of those together, we're getting close to $67,000 of taxable income. Now, those two sources by themselves provide plenty of money for someone to retire and have enough money to last their entire lifetime. What if, though, you did somehow manage to put money into an RSP on top of that? Let's say you have a $20,000 RIF income stream in retirement. So you add all those together, you're getting really close to $90,000 of taxable income. You can see why now, if you had a pension, you've got CPP and old age security, you're probably never going to need that RIF money. And so all that time you were trying to lower your taxes, you're just having to take and receive an income from the RRSP and pay tax on money that you really didn't need. And so your taxable income actually didn't go down during retirement, it actually stayed up, or maybe even went even higher because of the amount of RRSP income. So that is a scenario where if you have a pension, especially a defined benefit pension plan, it's probably a good idea not to use an RRSP and to talk with an advisor about how you can tax shelter your money going forward, how you can save taxes, that kind of thing. Okay, now some of you people out there that are very clever, very savvy around investing will say, but David, I can do income splitting. That's true, but have a look at this. Let's read this together. If you and your spouse are in different tax brackets at retirement, income splitting could lower the overall tax bill for your family. If you are in the same tax bracket, there would be no benefit to splitting your pension income. Okay, number 3, retiring outside of Canada. This would be another reason why you may not want to use your RRSP. You want to know, depending on the country you're thinking of going to, if that country has a tax treaty with Canada. At the time of recording this video, there are 94 countries that have tax treaties with Canada, and which is great so that you can go to those countries, retire, and not be double taxed. That's the reason why we have the tax treaty. The other reason is because it defines which taxes are covered and like who is a resident and who is eligible for other benefits. Those are the reasons behind tax treaties. So if you are thinking of retirement and where you might want to go to live, a beautiful sunny area, or where the cost of living is lower, you want to first find out, is there a tax treaty? Otherwise, you could be paying double tax. Number 4, we're almost there. Okay, why would this be a problem for you if you're a high income earner? Well, a high income earner at retirement is the exact opposite of what the whole theory behind an RRSP is. You want to make sure that you have a high income tax that you're contributing to and a low income tax when you're actually drawing the money out of your RRSP. But if you're going to have a high income, as we just pointed out, if you have pension income or other income such as rental properties, or maybe you choose to work part-time. You know, a lot of retirees choose to go back to work part-time because they're just want to be active and sociable and meet people. They're not doing it for the money. They're doing it because they just want to be out of the house. And so that just adds to your taxable income. So that is another reason why you may want to reconsider using an RRSP. Last one, let's have a look at this one. You're going to love it. Incorporated professionals. Look at this video up here. You're going to see some videos designed just for incorporated business owners as to how you could use your money in a different way other than RRSPs, because it may not be right for you. If you're an incorporated business owner, your company is absorbing all of your expenses for you personally. Not all of them, but the majority of them, right? And I'm not going to go through the list, but they're very obvious. Your company is paying for a lot of things that you, if you were not a business owner, would have to pay for yourself personally. So because your company is paying for those expenses and you don't have to pay yourself extra money to pay for that, well then that lowers your personal income tax. And RRSP contribution limits are based on your T4 income. And so if you have a low T4 income, that is then forcing you to not be able to put in as much as you want because your income is lower, 18% of your earned income. So that's why if you're an incorporated business owner, you know, an RRSP, it may be the only option or it may be the worst option. That's why talking to an advisor is going to help you to run scenarios as to which might be the best option for you. And again, look at this video up here so you can make sure that you've got, you know, the most options available to you if you're a business owner as to how to invest your money in a different way that would produce the same or better outcomes for you when it comes time to retire. Of course, I always tell people to get a financial plan done because it's seeing the outcome of your planning decisions before you commit to them. Financial plans are so invaluable. 2 out of 10 people actually have them. And when people use financial plans, they end up having more money. Statistically, it works out that way. If you have a financial plan, you're going to have more money to use in retirement than that of someone who doesn't have a financial plan. Hey, you know, we're all done. I appreciate you being here with me today. I always tell people we take care of your wealth management so you can take care of what's most important to you. Firmly believe in that. I appreciate your time. If you have any questions, please put your comments below and I'll be happy to get back to you as soon as possible. Thanks so much for your time. I look forward to seeing you in the next video. If you have any video ideas that you would like for me to talk about, please put them in the comments below and I'll be happy to talk about them. Thanks so much, and I appreciate your time. I'll see you in the next video. Take care.